Welcome. So, we will continue from the previous session. We saw how a pre-money, post-money valuation is normally calculated, and then how equity shares, value of equity shares go up, and then there are two ways of allocating equities, that is one from your share, another from the company, how you create. Particularly, the more important part was during that discussion is that valuation and number of equity shares that you allocate is not so much linked. What is linked is what percentage of equity that the investors is asking, that is more deterministic for deciding how many equities you are going to allocate. So, that is very important. Of course, valuation, equity, and then allocation and percent, everything is interlinked, but do not think that if the valuation is more, you are going to give them more shares. That is not the case. I just wanted to clarify that part. So, again the same topics. Now, there is something called venture capital method. Venture capitalists normally use some established rule, not a particular method or something, but there is this is one of the methods that they use. They normally use this return on investment. Suppose they will have some kind of a terminal value perception. What is terminal value? Terminal value is the value at which they will exit. Suppose they have a perception that they will exit after 5 years. So, that is their investment horizon. Now, after at the very particular moment, even before investing in your company, they will try to look at the 5-year scenario, means that 5th year scenario, that they are exiting from your company, and what is the situation, meaning what is the profit that they can expect in the 5th year, and then depending on the profit, what is the market value multiple of profit. Say 1 rupee of profit is going to be valued 1000 rupees, and then suppose your company is going to make 10,000 rupees of profit, then they will multiply that with 1000, because that is the market multiplier, and estimate whatever is the value at which they can exit. That is called terminal value. So, their return on investment is terminal value, or their value, their portion of the value, and no, it is not their portion, it is total value of the company divided by whatever today they are making post money valuation. So, today they think that they will be bringing some $1 million or something on the table in the company. So, that is, if they bring $1 million, suppose your company pre-money value is $4 million. So, 4 plus 1, $5 million is the post-money value, and after 5 years they see a valuation of say $100 million. So, 100 million divided by 5 million is equal to return on investment is 20 times 20x, means 2000%. Forget about percent, it is 20x. That is what is x in the realm of investment. So, they will tell you our expectation is 20x return in 5 years, given the risk that your company is exposed to. We expect, or we will be feeling comfortable with a return on investment of 20x. By this, what they mean is, they mean two things. One is they will exit in 5 years, that is a separate information, within, means at the end of 5 years they are going to exit, and they are expecting a value of 20 times their investment. Why I say their investment? Because post money also includes their money, your money plus their money. Your money meaning your valuation, pre-money valuation, plus whatever money they bring is the post-money value. Combine that together, sorry, your value, your company valuation before the investment and their money makes post-money valuation. Now, post-money value is going to inflate or increase 20 times. That is what is the terminal value. That is the whole meaning of this discussion. So, what is terminal value? Terminal value is nothing but revenue in the 5th year, then whatever is the earning on the revenue, earning means profit. Earning is a term that is used in US and perhaps Europe. In India, we use the term profit. So, revenue into profit percentage multiplied by price to earning ratio. I have made an example for you to understand what is PE ratio. Let us understand PE ratio. PE ratio is price to earning ratio, number 1. Price is the price of one equity share in the market. Now, normally people refer to marketplace, stock market, but if you are not thinking of market, you can even talk about price of 1 rupee of earning. Suppose 1 rupee of earning is valued at 20 rupees. That means, price to earning ratio is 20. Price is 20, earning is 1 rupee. So, whether you talk in terms of per share, you talk in terms of 1 rupee profit, or you talk in terms of the entire profit per se. Suppose your profit is say 1 crore rupees and your PE ratio is 20. So, you multiply that 1 crore with 20. So, value will be 20 crore. 1 crore rupees is the profit, price to earning ratio is 20, meaning every rupee of earning is valued 20. So, 1 crore rupees of profit is valued at 20 crore. So, your company value is 20 crore, as simple as that. Understand clearly step by step, it is given step by step. Earnings are earning per share, it may be 1 rupee also. Suppose the sales in year 5 is 1 crore rupees, that is what the venture capitalist is talking to you, or say angel is talking to you, that in the 5th year I guess that your turnover will be 1 crore rupees and your net profit will be something like 1% only. So, the net profit of your company is going to be 1% of 1 crore, which is 1 lakh rupees. Your company has 1000 outstanding shares. So, divide that 1 lakh rupees of profit by the number of shares, you get earning per share. So, your earning per share is 1 lakh divided by 1000, which is 100. So, your EPS or earning per share is 100. Now, suppose one share of your company is traded in a stock market in the 5th year at 10,000 rupees. That means, price to earning ratio is 10,000 rupees is the market price, 100 rupees is the earning per share, divide by that you get PE ratio of 100, that is the PE ratio. So, your investment, suppose the company, the angel invest 1 crore rupees, exit in the 5th year, revenue in the 5th year is 1 crore rupees, earnings is 1%, price to earning ratio is 100, terminal value in that sense will be 2 crore rupees. Forget about this line, terminal value 30 million, just forget about this for a while. Terminal value is equal to revenue multiplied by earnings rate into P ratio, which in our case is 1 crore rupees is the revenue, 1% is the earning rate, 100 is the P ratio that I showed, it becomes 1 crore rupees. Terminal value is equal to 1 crore rupees. Suppose this is another example, sorry for not mentioning it here. Terminal value in case the profit percentage is 20%, then rather than 1% it becomes 20. So, your terminal value will be 20 crore. 1 crore rupees is the sales or revenue, 20% is the profit. So, 20 lakh is the profit in that case, earning multiple price to earning multiple is 100. So, it becomes 20 crore rupees. So, exit value of the company at the time of exit is 20 crore. Now, they are investing how much? That they will estimate based on the 20 crore. They need 10x return, 10 times the return. Suppose they are sitting there and they think that your company should give them a 10x return, only then they will invest. So, they will divide your 20 crore of exit value by 10, you get 2 crore. That means, post money value of the company is 2 crore. If you remember this formula here, terminal value is nothing but post money value. if you divide terminal value with your 10x to 20x or whatever, that becomes your post money value. So, in this case the post money value is equal to 20 crore divided by their return expectation, that is 10x. So, you get 2 crore rupees of post money value. Now, they have already determined that your pre money value is 1 crore and your post money value is 2 crore. That means, they are bringing in 1 crore. They can bring in 1 crore. They are comfortable to bring in 1 crore. That is the money that they are going to invest. That is how they calculate. That is how the venture capital method is done. So, if you work backward, you estimate the terminal value after 5 years, then project all financing rounds to exit. In between, suppose we are slightly moving forward. Suppose in the 5th year, before the 5-year period, in between, say in the 3rd year or some time, you raised another round of funding. So, there may be multiple round of funding, but eventually when you exit, you have to backtrack and estimate the present value. Only then you can estimate how much money the angel or the VC will bring in, should bring in to get some kind of holding. That comes later. Work backward to determine the initial pre money. Now, let us see it with an example. Slightly difficult part, but follow very carefully, it is not so difficult. Now, this is the venture capital method of estimating how much money they should invest in your company. Assume that during exit your company valuation is 100 crore rupees. Look at the blue long bar, that is 100 crore, that is the exit, that is the 5th year. So, x axis actually increases, decreases moving forward. Series A is the 0th year, series B may be 3rd year, exit is happening on the 4th year. So, while y axis is 0, x axis starts at 5, 5th year, 3rd year, 0th year. Now, assume that you are exiting at a valuation of 100 crore and say you raised total capital of 10 crore. Total capital meaning from series A you have raised something like 2 crore, series B you have raised say 8 crore, series A of 2 crore, series B of 8 crore. So, let us see how this is decided as to what should be the valuation at series A or series B, how these are decided as per venture capital method. So, we backtrack as I said. So, first we have to see series B. Now, your exit valuation is 100 crore. Suppose your expectation is 5x return, not 10x, 20x, 5x return. So, how much is the post money value? Post money value, as I said, is exit money divided by how many x of return that you expect. So, 100 crore is the exit value and 5x is the return. So, divide 100 by 5, you get 20 crore, that is the post money value. If 20 crore is the post money value and you raised 8 crore of pre money funding. So, what is the pre money value? Post money funding. What is the pre money value? Is 12 crore. It is not M, actually I copied it from somewhere. So, that remained here. So, pre money value is 12 crore. 2 crore. Now, we move forward in the next part. The place from where I have taken the slide is given in the reference, the number 1 reference, and I duly recognize their work, and it is not just a blatant copy and claiming that it is mine. So, it is there very much in the reference part. I have changed some data, some units also for your understanding. I have added lot of things in between. So, 2 crore, now we have already come up that pre money valuation at the time of second round of valuation, second round of fundraising was 12 million. So, we will start from there. Now, 12 million was the pre money value of the second round, that we think now is the exit value. So, if 12 crore rupees is the exit value, what is the post money value of the first round? You remember that post money valuation is available by dividing the exit value divided by expected rate of return. Now, here the pre money of the second round becomes the exit value, because that is another round of funding. And suppose your first round of investor expect a 3x return. So, divide that 12 crore rupees divided by 3, you get 4 crore, that is the post money valuation. Now, you deduct the amount that you raise, that is 2 crore, from the post money valuation, you get the pre money value, that is 2 crore, as simple as that. So, I hope that you understand. I will just revisit quickly. So, for a complex situation where you have multiple rounds of funding, how you decide? You are sitting in year 0 and you are looking at the future. So, how you decide that how much money you should demand or how much money the investor should give you? You are in year 0. Now, suppose you have all this panned out, that you want to raise say 2 crore rupees today, and then 8 crore rupees in the third year, and then in the fifth year you are going to give all of them an exit. So, how much is the value? That should be estimated by back calculating. So, you know that exit value should be 5 times the post money valuation of the second round, or say the venture capital method of valuation in the fifth year is 100 crore, because they have estimated some kind of turnover in the fifth year and some profit percentage in the fifth year and some price to earning multiple in the fifth year. They have multiplied them and got a valuation of 100 crore, that is what is this blue bar. Now, you already know that they want in the exit, they want 5x return. Divide 1000 divided by 5, you get 20, and that is the post money valuation in the second round. Deduct 8 crore rupees of funding that you have received from them, you get pre money value, that is 12 crore. Now, you know 12 crore rupees is the pre money valuation in the second round, that becomes the exit value for the first round. Now, for the first round, your investor wants a 3x return at the end of 3 years, and the end of 3 years the valuation of the company exit valuation is 12 crore. So, 12 crore divided by 3x return makes 4 crore rupees, 12 by 3. That is the post money valuation of today, and pre money is 2 crore. So, post money is 4 crore minus 2 crore is 2 crore. That is the whole story here. Scorecard method, I will explain with an example. You determine median value for pre-revenue companies in your space. Suppose you are in say Android application developer. So, in Android developer, how things are selling, what are the valuation of different metrics of the company. So, you assign different weightages in different metrics, management, say IP, say promoter, founder, etc., or level of development. All these you just keep on assigning value, calculate the weighted average of each issue, and then multiply the median value of weighted average valuation to get your company valuation. Look at this. Suppose management, you think management is very important. So, management should get 30% of the valuation, size of opportunity get 25% weightage, product get 15% weightage, marketing get 10% weightage, competition get 10%. Now, you try to assess your own company. Suppose your company management is kind of wonderful. So, you want to assess 30% premium over the median value. So, your company becomes say or say 20% premium, not 30, 20% premium. So, you say management holds 30% weightage, and you think that your management is 20% enjoy 20% premium over the median company. So, you want to assign 36% weightage on that. Similarly, opportunity, you think your company enjoys 30% premium, So, it becomes 33% weightage. Likewise, the weightage are changes. So, weighted average becomes 112. Now, you identify companies which are getting sold or value evaluated. Then suppose the median value is 2 crore and your weighted multiple is 1.12, you get 2.3 crore. So, multiplied by 2 crore with 1.12, you get 2.3 crore of valuation. That is the pre-money valuation of your company, and that is how this scorecard method is used to value company. Now, there is something called risk factor method. Determine a starting valuation point, consider and assess risk. Like every stage you assign some risk point, say idea stage, say prototype stage, validation stage. Every stage the risk reduces. Consider and assess the risk, assign positive or negative values to each. Like suppose you have 10 companies, say you take one company and you find that they are at idea stage. So, for technology you assign -2 to them or -3 to them. There is another company who has gone to market already. So, rather than assigning negative value to them, you assign +3, +2, +1 or something. Likewise, you determine what should be the metrics based on which I will make the valuation. Then depending on the status of the company, you assign negative value or positive value, negative high value or positive high value, then make a sum of them and then estimate. Risk type, these may be some of the risk parameters or metrics. Now, this here is an example. Suppose you think that okay, maximum I will assign 3, minimum I will assign -3. So, 0 for pre-revenue period, +1 for beta stress testing, +3 for paying customers. Suppose they have acquired some customer. For each value you are going to assign say rupees 10 lakh added pre-money valuation, and for -3 you are assigning say 30 lakh rupees of minus valuation. Now, look at this example. Say for a particular company you think that management is doing quite good, meaning they are balanced. There are some engineers, a management graduate and they have experience credential. So, you assign +2. So, every value will be multiplied by 10. So, 10 into 2 becomes 20 lakh. Suppose state of business is kind of okay type. So, you assign a +1, it becomes 10 lakh rupees, you add to the pre-money value. Legislative, political risk, suppose it is neutral, there is no political risk. So, do not assign any value. Now, manufacturing risk, you think that there is quite a lot of risk. So, you assign -1. So, the pre-money value will be reduced by -10 lakh. Similarly, sales and marketing risk say -3. So, -3 into 10, 30 lakh rupees will be deducted from your pre-money value. Likewise, all the parameters will be assigned values. Then you make a kind of a base value. Suppose base value is say 22 crore rupees. Suppose you think that base value is 2 crore. Now, you add and subtract depending on whatever you want to add or subtract from the pre-money value. So, you have added 80 lakh rupees, you have subtracted 50 lakh, you got 2 crore 30 lakh rupees of pre-money valuation. Now, return drive investment decisions. Calculation generally did not include dilution etcetera. Then like say at every stage there might be dilution also. Valuation is an art, not a science. More important to calculate it rationally and not emotionally. Use multiple methods. Estimate valuations whenever conversation gets started. Now, here is the reference of Stephen Thau. My whole presentation is kind of inspired by whatever he said. You can see the Google search his presentation and you can see the presentation, but you will realize that my presentation is far different. There may be some 1 to 3 locations where I have taken some examples, but otherwise I have brought in lot of value to this domain. Concluding remarks: valuation is subjective. Investors make postures, like they will say your company has so much of loss, there is no value at all, but I will be kind of kind to give some value, be mindful about that, hard bargain. But remember, it is not necessary that high valuation is going to give you some kind of a winning proposition. In fact, many companies died because they had too high valuation. Do not go for too high valuation. Use multiple methods, meaning one method may not give you some kind of a wonderful idea or something. So, use many methods and take a pessimistic, realistic and optimistic view, and eventually make some kind of an average that okay, let us settle with this, and if the valuation is like that, you should be happy with that. Hope you understand something from this. Thank you very much.